All right, let's get right into it. Today we are diving deep into the technicals of a stock that has become an absolute battleground for traders, YYAI AirWA Incorporated. Seriously, this thing is one of the most volatile names out there right now, so we're going to dig in and see what the charts are really telling us.
And this really gets to the heart of the whole thing, doesn't it? When a stock just completely craters like this, down 98%, you've got two camps. Is this a golden, once-in-a-lifetime buying opportunity? Or is it a trap, a financial black hole ready to swallow up your money? That's what we're here to find out. And the clues, well, they're in the charts.
I mean, just look at how fast this all happened. We're talking about a stock trading near $5 in late August, and by the end of October, it's worth less than 8 cents. That is just a spectacular collapse. And it wasn't a slow bleed either. You can see these moments of just insane trading volume, like that spike of over 133% on October 22nd. This thing didn't just decline, it went straight off a cliff.
Okay, so, Section 1. Let's talk about YYAI's wild ride. Before we can even begin to look for clues, you've got to understand the pure chaos surrounding this stock. Context is everything here.
Get a load of this number, 469 million. That's the number of shares that traded hands in just one recent session. To give you some perspective, that's more than double its usual average volume. So this isn't some quiet, orderly selling. This is an absolute frenzy, a battlefield of heavy-duty speculation.
So that leads us to our next section, the overwhelming downtrend. When you take all that chaos and you start looking at the actual technical evidence, one picture becomes incredibly clear. And unfortunately for the bulls, it's a picture of a massive, overwhelming downtrend.
Okay, before we get into the nitty-gritty, let's talk about moving averages really quick. It's a key concept. The easiest way to think about them is like this. The daily price of a stock is like the chalky waves on the surface of the ocean. But the moving average? That's the deep, powerful underlying current. The waves go up and down, but the current, that tells you where things are really headed. And here is Exhibit A. The proof is right in the pudding. The current price, sitting around 8 cents, isn't just below one moving average, it's below all of them. Short-term, medium-term, long-term. It doesn't matter which one you look at, the answer is the same. That deep ocean current we just talked about, it is pulling this stock straight down, and it's pulling it down hard.
And it's not just the moving averages. Not by a long shot. It's like all the other technical indicators are jumping in to agree. You've got the ADX, which tells you how strong a trend is, and it's screaming that this downtrend is powerful, not weak. Then you have momentum indicators like the ROC and PPO. They're so negative they're practically falling off the chart. It's like a whole chorus of signals singing the exact same song. The sellers are in total, absolute control here.
So, you think that's it, right? Case closed? But this is where the story gets really interesting, because despite all that overwhelming evidence pointing down, if you look really, really closely, there are a few little clues that maybe, just maybe, a comeback could be on the cards. Let's dig into those.
So, to find these clues, we have to look at something called the Relative Strength Index, or RSI. Think of it like a momentum meter. My favorite analogy for it is a rubber band. You can only stretch a rubber band so far in one direction before it has to snap back, right? Well, a really low RSI value suggests that the selling has been so intense, the rubber band has been stretched to its limit, and it might be ready to snap back.
And what is YYAI's RSI right now? It's at 29.84. Now for traders, the magic number is 30. Anything below 30 is officially considered oversold. So this is a textbook signal, a classic sign that the sellers might just be running out of gas. That rubber band we talked about? It could be primed for a snapback rally, even if it's just a short-term bounce.
And here's the thing, the RSI isn't seeing this alone. There's another indicator called the Stochastic Oscillator, and it's basically flashing the exact same deeply oversold warning light. Plus, if you squint, you can see a tiny little bullish signal starting to form on the MACD. Now I have to stress, it's a very subtle hint, but it suggests that this freight train of downward momentum might finally be starting to lose some steam.
This quote from the analysis really says it all. The minor bullish crossover offers a glimmer of recovery, but the negative MACD value maintains a bearish outlook. And that's the perfect way to put it. You've got this tiny glimmer of recovery, this one little positive sign, but it's trying to survive in the middle of a massive bearish hurricane. So let's be clear, this isn't a green light. It's more like a single candle flickering in the wind.
So we've got this massive storm pushing the stock down, and this tiny little flicker of hope. What are we supposed to make of that?
Well, it's time to put it all on the table and look at the two competing scenarios, head to head. This is the bull case versus the bear case.
Okay, so it really all boils down to one critical price level, about 7 cents. The whole bull case depends on the stock finding a floor there, holding that support line. If it can, the bulls are hoping for a bounce up to the next hurdle, around 9 cents. But the bear case, well, that's what happens if it breaks that 7-cent floor. If that support fails, the big downtrend probably takes over again. And the scary part is, the next theoretical stop could actually be a negative number.
All right, final section. Let's wrap this all up and talk about what it really means. We're going to cover risk, reward, and the final verdict.
First things first, we have to be crystal clear about the risk. The charts are not whispering caution, they are screaming it. I mean, look at this volatility reading, over 347%. That is just off the charts. It means this stock can swing wildly in price without any warning. You combine that kind of volatility with intensely negative momentum and a powerful downtrend, and, well, you're looking at the textbook definition of a high-risk trade.
So given all that, how should you even think about this stock? The analysis basically lays out two different paths for two different types of people. Path 1 is for the short-term, nimble trader. For them, that little glimmer of hope, that oversold RSI, might be a signal for a quick in-and-out trade trying to catch a small bounce. But path 2 is for the long-term investor, and for them, the message is loud and clear. Avoid this thing until you see a major confirmed change in the trend. And that process wouldn't even start unless the price gets all the way back up over 76 cents.
And that really brings us to the bottom line, the final verdict. When you boil it all down, YYAI looks like a high-risk playground for very experienced short-term traders who love volatility. But for pretty much everyone else, especially long-term investors, the charts are sending a very clear message. The trend is not on your side, and the safest place to be is on the sidelines.
So there you have it. The technical picture shows a stock balanced on a knife's edge. It is a classic falling knife scenario, and we've laid out all the immense risks of trying to catch it. Which leaves us with one final big question, a question the charts can't answer. After seeing all this risk, what in the world is the reward?